Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and markets have continued on this diverging path that we started to highlight here last week, with further weakness from specific sectors like the higher beta names that we talked about. So the question comes from investors right now as to how do we plan for going forward? Is this contained? Is there further weakness? Those are some of the things that I want to help answer during today's session. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off like we normally do with the major market indices and see where that bifurcation is currently sitting and how do we account for that. We'll take a look at sector rotation to get a better sense for within the specific sectors where we see strength, where we see weakness, so that we can position it correctly within specific sectors, and also dive a little into some of the subsectors, if you will, that we see most of the weakness from, and how do we use that information for our investing. Then I want to take a look at the full spectrum of fixed income and what those markets are starting to tell us, and specifically some warning signals that we see from fixed incomes that may have some major ramifications here for equities, major ramifications for commodities, and take a look at some of the shifts in economics that we have seen that inform our decisions and I would say confirm some of our views that we expressed here last week before sharing with you a few of our ideas for today's session. But the primary question that I want to help investors answer, which is something that we started to explore here last week, is can we expect further market weakness, or is this pullback a market buying opportunity? Largely, most of these pullbacks that we have seen, similar to the ones that we're currently experiencing, have been buying opportunities, but is this time a little different? So that's what we want to try to answer. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my statistical research, and everything that I'm using to help inform my decisions as to how I'm positioning my portfolio for this current market. So we'll start off with the S&P 500, which on the weekly chart remains extremely strong and resilient. However, we are starting to see signs of exhaustion here, where we push higher highs on price, but as you can see here on momentum, no longer confirming those highs. So when you compound that with the fact that the S&P 500 has been above the 21-day moving average for almost a month and a half now without a pullback below the 21-day moving average, that certainly puts a higher probability of the S&P 500 pulling back, potentially as low to that 398, 397 breakout level that we saw here in early April or late March. And then when we look at the QQQ, the NASDAQ 100 index, we have this double top that we spoke about last week that is so far held, breaking down below that level, coming to retest this level as resistance and getting rejected off that level here yesterday. This certainly puts the NASDAQ 100 on a much more weaker foot here. It does have some minor support here around this 320 level here, but in my opinion, more likely that we may see a break below that level and potentially get down as low as 310, maybe even 300 here to the downside, which would correspond here with a major support and resistance level that we have seen since the election. It also corresponds roughly with the 200-day moving average here to the downside. So this 298, 302 level here in this area, very well potentially a target here to the downside if we continue to see weakness. And I'm going to show you some of the fixed income markets that may suggest that is in the cards. When we look at IWM, small caps remain very neutral here, if you will. You can call it a rectangle, if you will, for small caps after what is a very, very strong move here to the upside, a long period of consolidation, which is very common after such a strong period of outperformance. And now we're trading near the bottom of this range. IWM, perhaps remaining range bound here, but watch for a potential break here below 215. If you see a break below 215, you only have some minor support here around 205 before the next support level here comes in around the 200-day at the 190 level here to the downside. So you have quite a few of these equity markets starting to push these support levels, and we really have to pay attention to see if they hold. If they don't, we are likely to see further downside here from the major equity markets. The one bright spot here in the broader markets is RSP, the equal weight S&P 500 index, remaining on this very strong grind here to the upside. So the RSP, the equal weight S&P 500, outperforming the market cap S&P 500. This is something that we've been highlighting for the past few weeks, and this really speaks to the fact that the smaller cap names in the S&P are doing significantly better than the mega cap names. So the mega cap names trading at very rich valuations are starting to see that multiple contraction. The broader markets are actually rallying and actually seeing some strength here. That is still supportive of the broader markets. That's why we're not outright bearish on the markets here right now. When we see this type of market breadth also see some weakness, that is a pretty good sign of a potential market correction here. And we're not seeing that just yet, but we're starting to see some evidence of exhaustion. We're starting to push some support levels. These are important times to pay attention here in the broader markets because we are at a pivotal, I would say at a pretty pivotal point in the broader markets. We highlighted a shift in equity markets last week where we have been largely very bullish on the markets. Last week, we started to shift to a much more neutral, slightly bearish tone here. And this week that is continuing here. But right now, we are at the verge of potentially shifting even further to the downside if we start to break some of these support levels. And then for those of you that have been following us for a while, we've been talking about value versus growth, how value has underperformed growth for many, many years. And we've talked about this bottoming formation that we've seen in value versus growth and the outperformance here for value versus growth, where it started to outperform here in late February, came back all the way to retest this level here in April and is now a rebounded level. This is a confirmation from my perspective that value is that we've seen a significant shift in the broader markets, in equity markets, away from growth stocks. This is why we've been shorting growth stocks heavily here over the past few weeks, and we've been positioning only in terms of longs on the value side of things, looking for value-based names like Morgan Stanley, Procter & Gamble. These are the names that we want to remain long and short these higher beta tech names because of the charts that we're showing you here in this particular market. And then when we look at the sector rotation, look at the sectors that are outperforming: financials, materials, industrials, even energy. Energy largely because of the rally we've seen here in oil. We've also had the gas, the pipeline disruption here in the US. That's likely to cause potentially a little bit more upside here for oil stocks and energy stocks. But consumer staples leading in the improving category, and all of the higher beta names, discretionary, technology, healthcare, utilities starting to improve a little bit here to the upside. Utilities certainly I would not consider as higher beta. Utilities showing a little bit of strength here, and communications also, which is higher beta, starting to decline here as opposed to getting into that leading category. So we continue to see this shift here away from higher beta into more value-based, more industrial type names here for the economic recovery that we're in. So the trend that we started to see emerge here a couple of weeks ago still remains in place. We're not seeing evidence of rotation here. We're not seeing these names start to rotate lower here and some of these tech names and discretionary start to come up. We may start to see some of that here in the next few days, but this is one that we're not seeing just yet. So we're not quite, I don't think it's time to start buying these tech names. Same thing here in ARKK. This is, I think, a good representation of this higher beta, not profitable, higher growth tech names. And like I said, within this specific space, there are candidates that I think are very, very weak. And those are the ones that I've been pointing out here over the past few weeks with Fastly, with Palantir, with Etsy, and Netflix. These are stocks that are relatively high growth, but slowing down in terms of revenue. These are companies that are not profitable, and these are companies trading at ridiculous valuations. These are the companies that are coming in hard and fast. And ARKK largely is an ETF that represents many of these names. As you can see, breaking below a triple bottom here around 110 or so to the downside. You broke below the 200-day moving average as well. This certainly puts $90 here to the downside into targets, potentially, the $85 here target here to the downside. Those are the minimum targets that I would see in some of these names. So as we look for opportunities here in the broader markets, many of them I see as are still to the downside, that there's further downside in some of these names. So to answer your question, is it time to buy some of these names? I don't particularly think so. And then we have to look at fixed income markets to understand a little bit about the expectations, perhaps that we're starting to see here from the equity markets, and the fixed income markets are telling us something. So the 10-year yield here, as you can see, holding this 155 basis point level here to the downside. We haven't talked a lot about interest rates because largely after this big move here to the upside from 100 basis points to 155 basis points, the market is largely consolidated here, meaning it has not moved higher or much lower here, but it is holding this 155 support level here. And this is putting in a bit of a bottom here for rates, and it gives the rates an opportunity to potentially start to rise here. Now, I don't put a lot of weight behind the technical analysis, if you will, of yields, because again, I believe that yields are far more driven based on monetary policy and economics. But the one thing that we can apply some technical analysis to are bond prices. As you can see, this is TLT, longer dated bonds on a fairly downward trajectory before actually breaking below this downward trajectory and actually accelerating here to the downside. And what we have here after this acceleration here to the downside is what we typically call a consolidation or a continuation pattern here, where after a long period of underperformance, you have a period of rest or equilibrium or consolidation, whatever you want to call it. And then right now, even though it hasn't broken yet, this is one that we're paying attention to, because if TLT continues its weakness here, this could project significant weakness here to the downside based on this chart pattern. You've had a move from about $154 to the downside, about 137. That's a 155, 137. That is a $18 move here to the downside. So when you have an $18 move here to the downside, that can project here from around 137 to the downside. You're talking all the way down to about 119 or so. So that's a significant move to the downside in TLT. And but I want to warn investors, we have not broken that downtrend just yet. So this very well could continue grinding higher here. That's not to say that this can't grind higher for a period of time before breaking down, but this is one we're at a pretty pivotal moment here to pay attention to for a potential breakdown here. But we see a very similar pattern here for LQD as well. After this is the investment grade ETF for bonds. After a downtrend, a period of consolidation, and also a potential opportunity here for this to break down. But again, also LQD has not broken down just yet, but this is one that we're paying attention to. And HYG, high yield fixed income, still by far the strongest out of the three in terms of the risk spectrum. The riskiest bonds are the ones that are best performing here at the moment, but it has failed to make a higher high. Momentum is starting to slow down here. As you can see, RSI is now below 50. That certainly starts to shift momentum potentially a bit here to the downside. So this is one that is very important to pay attention to, as we're starting to see a shift in momentum here for bonds, and that does potentially increase yields to the upside. If we see a rise in yields, that's going to continue put pressure on specifically the higher beta tech names, also some of the higher valuation names that we're currently seeing in the market. Some of the richest valuations that are really concerning me right now are actually some of the hospitality, the travel stocks, the ones that have priced this reopening to perfection. Yet we're not seeing significant upside in some of these, whether we're talking about hotel rooms or airline stocks. We're not seeing them return back to normal by any means, yet they're trading significantly higher than where they were prior to the pandemic, and at least from a valuation perspective. And those are some of the names that may also see some weakness here going forward. So as we look for opportunities here in this market, these are some of the places that we really have to start paying attention to. And if we look at gold here, Looking at the weekly chart, there's a few different ways that you can take a look at this, and it's not quite clear as to which way it's going to play out here, but gold, strong rally here from the $120 level here or so in 2019, all the way up to this big move we had here to the upside. And just like what we saw in treasuries here, you've had this long outperformance. Now we've had a consolidation period, and the question is whether this breaks out higher and continues significantly higher here on gold. This is one to pay attention to. Gold could very well just continue in this downtrend and start moving here to the downside. That's the part that's not clear, but we are at a pretty pivotal moment, because if you look at the daily chart here, you have this resistance level that corresponds roughly with the 200-day moving average, which has largely have been flat here. And if we have a breakout here above this resistance level and a breakout here above the 200-day moving average, that certainly puts gold potentially all the way up to this 182.5 level here pretty quickly to the upside. So this is really where we're starting to see some pretty pivotal moments for quite a few different asset classes: fixed income, equities, commodities. So these are times to really be paying attention to, because you can catch some pretty sizable moves if you pay attention to these markets that are largely very highly correlated. And then if we look at the economic side of things, we had a fairly substantial surprise here to the downside in terms of the labor markets. This is some of the things that we started talking about last week, where we talked about the fact that wage growth, job growth here has slowed down substantially. We had talked about the labor costs. We've seen a substantial shift in terms of labor costs, and this is causing some really serious ramifications here. We were expecting to add about 1 million jobs in April, but we only added about a quarter of that, 266,000 jobs. The only bright spot of that job report is the fact that the vast majority of hires came from leisure and hospitality, almost 350,000 jobs added in leisure and hospitality, while we had quite a few lost in terms of transportation and professional services. Lost in April here in terms of jobs. Retail and manufacturing also lost some jobs here in April that offset the strong hiring that we saw here in leisure hospitality. So labor is becoming a really thorn in our economic recovery here. Basically, we're seeing a larger and larger bifurcation between job openings and job applicants, whether it's due to the stimulus in terms of making it less attractive for workers to get back to work based on the amount of stimulus and unemployment that we're receiving currently, or it's due to the inability to access childcare, where people cannot go back to work because they don't have anywhere to put their children. There's a multitude of factors here that is causing this shortage that we see here in labor, but that's causing labor inflation. So wage growth has grown substantially. It's becoming increasingly harder for employers to hire workers. They're going to have to pay workers substantially higher wages in order to attract workers. And this is going to cause some inflation for consumer goods, and when you compound that with the inflation that we're seeing from raw materials, this is going to cause some serious inflation here with respect to consumer goods. This is going to probably have a hit for consumer discretionary, consumer staple type stocks, but it also potentially has a beneficiary in industrial and material type names, where as labor costs rise, this usually, stimulates investments in automation away from labor-intensive, roles. Wherever there's a labor-intensive role, those are the ones that are likely to see automation or more automation and reshoring of supply chains to the U.S. And that provides both opportunity and some downside here for some sectors. So we continue to see this bifurcation that this rise in inflation is starting to cause. 800% increase in S&P 500 companies talking about inflation during their earnings calls. We've never seen that type of growth over the past 2 decades. So inflationary concerns is a big concern, and is something that I think we need to take seriously in the broader markets, and not just say that it's temporary, it's going to likely go away here. And then when we look at services PMI, this is the one part of the market that we've been talking about. We need to see a strong economic recovery from services to go alongside with manufacturing because the equity markets have largely priced this in that services is going to rebound. We've largely have seen that services rebound, but we're also seeing a little bit of a slowdown here in terms of services. If you look at market, it looks fairly strong. ISM survey was a little weaker than expected, but also manufacturing. Whether that manufacturing PMI can continue that strength here. And we're starting to see slowdowns in manufacturing here as well, as we saw retail and manufacturing, the two segments of the market that saw some job loss. So we may very well see some slowdown here with across services and manufacturing. And if we do, that again also puts this equity rally here, in my opinion, at risk, as it cannot continue to price in the markets to perfection. So as we look for opportunities here in this market, we have to be very careful and very selective in how we select for opportunities. So when we look on the long side, we really have to focus on sectors that have a strong fundamental reason as to why they will continue to do well here in the market environment that we've specified, and taking a look at the rotation data to see where is their strength, where is their outperformance here in the broader markets and position there, and then where is their weakness, where is there sectors that are going to underperform, and short those specific names. So when we look at ideas here, Parker Hannifin stands out to me from an industrials names perspective. Relatively strong name here to the upside. Potential breakout candidate here, especially for companies focused on automation, especially as labor costs rise. This is going to cause a substantial shift towards automation. So firms like Rockwell Automation and Parker Hannifin, these are the names that are leaders in this particular field in terms of helping manufacturers build machinery for automation. So those are the opportunities that we want to pay attention to in strong sectors like industrials with strong fundamentals in the current environment that we're referring to. Same thing here for Procter & Gamble. Consumer staple stocks are the ones that are doing better here right now. Those are the ones that are rallying as these tech names are selling off. As investors are selling off their tech names, they're flowing back into value-based, dividend-paying sectors that are largely going to weather some of this volatility that we're starting to see here. Procter & Gamble recently breaking out from this resistance level here to the upside, came back to retest this as support and confirming that, and currently at this triple top breakout potentially for a move higher here on Procter & Gamble. So as you look for long opportunities, you have to be very selective. These are the types of names that you want to pay attention to. And even with that, I don't necessarily know that this guarantees that these stocks will move substantially higher here, given the market environment that we're in. So on the flip side, you really have to look for some of these names that have largely priced to perfection, that are starting to see revenue growth slow down a little bit here in this broader markets. And one name that comes to mind is Micron, because as you can see, Micron, higher highs in price over the past few months. As you can see here in terms of the negative divergence, lower highs in RSI, and recently breaking below this 82.5 support level here to the downside. Once you have that breakdown of this major kind of topping formation or signs of exhaustion, this would potentially target here to the $70 here to the downside, which corresponds roughly with the 200-day moving average here to the downside. So when we look at chip shortages, that's certainly one thing that is pressuring some of these chip stocks, but also you can look at a little further beyond the chip shortages. Look at the amount of capacity that a lot of these chip companies are starting to add to offset or try to deal with the chip shortages. And we're seeing a flurry of capital expenditure across the entire chip manufacturers, Taiwan Semiconductor, Samsung, NVIDIA, Intel, all increasing capacity. Well, the question is the amount of capacity that's being added, is that going to provide more supply than there's a need for demand? And I think markets are starting to rethink about this in terms of the amount of capacity that's being invested in growing the chip market to deal with the chip shortages. Perhaps we're investing a little too much for the future. And this is some of the chip stocks, perhaps pricing in a little bit of a concern that supply is going to outstrip demand going forward. And lastly, like I said, it's not just in the tech names that we're looking for short opportunities. You have to also look at some of these hotels, some of these travel stocks. Think about stocks like MGM. RevPAR, meaning revenue per room, is still about 40 to 50% below pandemic levels. Granted, some of these names have some, interesting plays with sports betting, like MGM has BetMGM. But still trading at substantially richer valuations than prior to the pandemic, despite revenues being down 40, 50% prior to the pandemic levels. And we see the same levels of exhaustion here to the upside as markets continue to make higher highs in terms of price, momentum no longer confirming those higher highs. Now, MGM has not broken down like Micron has yet, but I do think it's at risk here, especially if you look at Marriott that just reported earnings here earlier this week. Not a particularly strong number here. I don't think this particular bodes well for some of these luxury names. It's really the luxury hotels that are actually not doing very well. So this is at risk, in my opinion, of pulling back here to about $32 here to the downside. And I think that's a more reasonable level for these stocks to be trading at, because again, travel has not resumed to where it was before. And you have multiple contraction here for some of the gaming stocks. Look at DraftKings, look at Penn National, significant weakness here to the downside. MGM, exposure to that same segment. So when you have, rich valuations from the travel side of the business, and you have rich valuations on the casino or the online sports betting side of the business, and both sides starting to look a little bit weak, but the stock price has not declined yet, that is an opportunity, in my opinion, but to the downside. So as we shifted, our views here over the past, I would say 4 weeks or so, where we started to far more look for downside opportunities going into this earnings season. I don't quite think that we're just done with that yet. I still think that you have other segments in the market like travel that may see some downside here, and I see some more downside here from tech. And you really have to pay attention to some of these pivotal things that I'm talking about with gold, with interest rates, with some of these equity major indices trading at support levels. If we start to see breakouts or breakdowns from some of these levels, that could provide even bigger opportunities here over the next few weeks. So pay attention to that. We'll keep you updated here on our Tuesday morning sessions here. So please make sure that you subscribe to us on YouTube if you're following us here on the live stream, or if you're watching this as an OptionsPlay member, to continue to come back here to our Tuesday morning session. So with that, I just want to thank our members for supporting us and allowing us to continue to do this. If you are currently, if you are not an OptionsPlay member, you can sign up for a free trial at optionsplay.com. It's a free full 30-day trial. It'll give you access to everything that we provide here in terms of education, in terms of the trade ideas that we send out, and the Tuesday morning sessions. And I hope for those of you that are currently on a free trial that you consider supporting us and becoming a member so that you can have access to everything that we have to offer. With that, thank you so much. I hope that you guys have a great trading day, and I will see you guys here this Thursday on our next options education session. And next week, on Wednesday, we're going to be doing crypto trading with Tom Sosnoff and Tastyworks. I know many of you are trading crypto these days, so I'm very excited to do my first crypto trading session here with Tom Sosnoff. Really looking forward to that and hoping to see many of you there. Thank you so much and have a great trading day.